So we're here with Steve Grossman, and I'm reminding you that he is from New Jersey Lenders, and he's a partner in New Jersey Lenders and a top-ranked mortgage originator for nationwide, actually. So thank you so much for being here.
You're welcome, Stace. Thanks, man.
We're going to jump to the next topic,
Great.
and in reference to the interest rates rising. So everybody probably knows interest rates have been rising, and would you agree that they're forecasted to continue to rise in the upcoming months?
So interest rates have clearly risen. It's forecasted that these recent rate increases, it was predicted. It is forecasted that the short-term interest rates will probably rise, that the Federal Reserve will probably raise rates 3 times in the next probably 12 to 18 months. That will impact short-term rates. As far as mortgage rates, who's to say what's going to happen with the economy, but the trend is that they may go up in time a little bit.
So what we know is that mortgages for new purchases are about, I think, 80%.
The out of the total, that you're correct, the total mortgage origination volume in the United States, 80% of all transactions are purchases.
Okay, so 20% would then be refinances.
Correct.
So with interest rates going up, why would somebody refi? Is there a reason to do it? Is there not a reason to do it?
It's a great question.
Thanks.
Why? Yeah, it's like, why are people refinancing? Is like, have they not refinanced already? But no matter where rates are, people always refinance stays. But what's happening now, there's a variety of people refinancing. One is maybe some people were asleep at the wheel, or their credit wasn't up to speed where they couldn't take advantage of low rates. A lot of people with the recent appreciation in homes have been looking at their home as a source of equity, been refinancing to take cash out or doing debt consolidations.
A lot of our clients we know decided, well, you know what, I'm not going to be in the house for 30 years. I'm going to go take an ARM, because the ARMs are going to be much less than the fixed rate mortgages, and this was even back when the fixed rate mortgages were in the 3s, right? You could still get an ARM for less. So now those people have ARMs, and now we see the mortgage rates are climbing higher than these ARMs are adjusting to. Is that what's happening?
Kind of. So what happens is with the adjustable rate mortgages is after they get their hybrids, after the fixed rate component of the product, they reset every year. So as interest rates are on the decline, these individuals got the benefit of a low initial rate, and the rates even went lower. So now, as the short-term rates have risen over the last 2 years, the adjustable rate mortgages, as they resetting, they're going higher. And the way the short-term rates are and the margins on these loans, many consumers are paying fully indexed rates higher than what you could get on a current fixed rate mortgage or on another adjustable rate loan. So if right now they fully index at about 5%, if the forecast come to fruition, these ARMs are going to reset probably in the next 18 months as high as 5 3/4.
Okay, so there's a reason to refi. So I'm going to put you on the spot.
Sure.
And I'm going to ask you what everybody is curious about, which is, where do you think these mortgage rates are going to go?
I'm going to give you the answer you don't want to hear. They're going to go up, they're going to down, or stay the same.
Oh, come on.
No,
That's not good.
I have no clue. I'll be honest with you, it's all predicated. If the economy continues and the stock market doesn't have a correction, interest rates will probably continue to rise. If there's something that happens in the overall economy or something in the stock market, what historically happens when we get into a recessionary period, the Fed steps in and lowers interest rates. So as long as nothing, an external force, doesn't cause the Fed to step in, most likely the rates will continue to rise.
So
How much more, I don't know.
So let's be clear, right? So the external force would have been like in 2008 when there was the banking crisis. That was an external force, and that pushed, or if gas prices just soared, something like that could really be a push to go down. But right now we are scheduled to go up. Interest rates are still historically very, very low, right?
Yes.
And so at this point, if interest rates rise a quarter, a half a point, what does that really mean to a buyer? Let's say there's a buyer and they're buying a house for $1 million, they put 20% down. So what is that difference for them on a monthly payment?
On an $800,000 loan, if the rate goes up 0.5%, the difference in payment is about $250 a month.
$250. So I really think the message is, things aren't all that bad. Interest rates are still very, very low, although they are probably going to get higher. And I think that the consumer needs to decide whether or not that $200, $150, $300 is a lot of money, or is it not a lot of money? I mean, that's really up to them,
And
right?
Stace, if the rates do rise, people will go back to an adjustable rate market to keep the rate at that payment they're looking for. And what goes up comes down. At some point in time, the rates will come back down and they'll have an opportunity to refinance.
Right. Overall, interest rates are still historically low, and there might be some really good opportunities in an ARM now and in an adjustable, right? So that would be something that somebody should call you on and talk about, right?
It's worth considering depending on the size of the loan, how long they plan to be there, and what the risk tolerance is.
And before I let you go, I have one last question for you. Oftentimes when a buyer and a seller are in a transaction, the seller looks to see how much down payment a buyer is putting down, and then considers that the higher the down payment means that the buyer is more qualified or less qualified. And so my question is that accurate, Steve?
No, it's not necessarily correct, because you have to, putting everything being equal, you know, is their both credit the same? Is their debt to income ratios the same? That's another part to it. And the seller in many instances feels that if the house under appraises, the person with 30% down is still going to buy the house. That doesn't necessarily mean that they're not going to want to go back and renegotiate. And the same thing with the person putting 20% down.
Right.
So it's really, you have to look at not just the down payment, but the credit worthiness of the individual,
Right.
and recognize if there's a value concern, you're going to have it with the 20% down or the 30% down.
Right. So basically, you have to look at the whole picture.
Entire picture.
The whole picture. And if you have a concern about the house appraising, the value, that's going to be there regardless of whether the buyer is putting 10, 20, 30, or 40% down. So Steve, you are New Jersey Lenders, you're a local lender.
Yes.
So what I want to know is, what is the one benefit above all that you believe is the benefit of working with a local lender?
Well, when specific to the value that we were just discussing is that we use local appraisers.
So you use local
and
appraisers, end of story.
That are familiar with the market.
That are familiar with the market. Okay, so that's the one most important value. And I appreciate you being here.
Thank you.
And we are so thankful for Steve for joining us. We're thankful to Steve Grossman of New Jersey Lenders for coming on our Stacey Esser Group video blog, and we're talking all things mortgages. And I hope that you can like us, follow us, and call us for any of your real estate needs. And again, it's Stacey Esser, and thank you so much for watching.